welcome. You're watching The Money Show. I'm Kavita Thapliyal, and this is the show where we take care of your investments and your financial goals. That's right. We help you align all your financial investments with your financial goals, whether it is short-term, long-term, your retirement, child education, or maybe their marriage or something, even short-term, like a foreign trip. So we help you strategize all your investments for the right financial goal, and we also answer your portfolio queries. Just in case you're watching the show live and want to send across your questions, the WhatsApp number is flashing on the screen. The email ID is also flashing as well. You can send across your current investment details and also ask us or give us the information of your time, of your financial goal, and we will align it with your investments. And let's begin today. The beginning of the month often marks key financial activities like salary, credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. Now, to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as part of this campaign, we ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on, set your reminders to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And today on the show, we'll be focusing on something very important as per this particular campaign. When we talk about Gen Z and investing, the conversation usually starts with crypto, trading apps, quick money. But here's the reality. Gen Z is also the first generation to start earning early, invest digitally, and make financial decisions without traditional intermediaries. Now, mutual funds may not look exciting on Instagram or YouTube, but they remain one of the most powerful tools for long-term wealth creation, especially when we start early. And increasingly, Gen Z investors are choosing direct mutual fund schemes, buying them through online platforms like Grow, Paytm, and other apps without distributors or agents. So today, we are asking a simple but very important question. Why should Gen Z care about mutual funds, and how do direct schemes really work, and what mistakes should young investors avoid? So let's break this down. I have with me Pankaj Mathpal, who is the guest today. Pankaj, hi, good evening, welcome to the show. And yes, we're talking about Gen Zs. I know you have kids who are almost between Gen Z and millennial age group. But, most Gen Zs now, they invest really well, more excited about crypto, individual stocks, and short-term trading apps or activities. Why should someone in their early 20s even bother thinking about mutual funds?
Kavita, good evening, and thank you very much for having me on the show. See, as you rightly said, that mutual funds are not like exciting product; they are a little boring. And this Gen Z, when we talk about them, they have a fast money mindset because they have seen 2020 format of cricket as compared to test matches, or they are more into uh, quick service restaurants or fast food. Everything what they see or they have seen since their childhood is something quickly they are receiving. So that is why when they want to invest, they more consider investing stocks, which is more exciting, or like crypto. But as you rightly said, if you want to create wealth, you want to achieve your financial goals, mutual funds will be more helpful in that compared to investing in direct stocks, because when you invest in mutual funds, these are managed by the professionals. And as when you invest directly in stocks, you may not have time, you may not have access to research, may not have sufficient knowledge of picking stocks. And that is why mutual funds gives you diversification, professional help, as well as discipline. So in long term, when you invest through mutual funds, you get the benefit of rupee cost averaging, you get the benefit of power of compounding. So for creating wealth, mutual funds may be more helpful compared to buying stocks or investing in crypto.
That's right. That's the differentiation that's really needed. But for young investors, it's very important for them to think of long-term investing, which apparently they are clearly not doing it. When we talk about Gen Z, when we talk about mutual funds, it's less exciting, but it is much more competent, and you really need a disciplined approach for that. But what about investing through a direct line, okay, regular mutual funds and direct mutual funds? Now, Gen Zs, they are very well versed in terms of knowledge. They browse, they compare, they gain whatever information is right for them, and want to, have a hands-on approach when it comes to their investments. Now, talking about direct mutual funds, why is there so much of interest in direct mutual funds, and as compared to the earlier generation specifically, what are the advantages and disadvantages then?
See, Kavita, as you said that they have knowledge, I agree with you that they are more techno savvy. They understand that how to make transaction. They have information, but again, where the information is coming from, that is very, very important, because they are mostly influenced by reels or social media. So sometimes the information what they're getting may not be really means worth trusting. So that is why um, see, they have two choices, direct versus regular. There's nothing wrong in investing in direct plan as well. But as I mentioned, that the information which is available that may not be trustworthy sometimes, and they may be influenced by that information and may take incorrect decisions. So if you compare direct versus regular plan, both have exactly same portfolio, same stocks or same assets in the portfolio. Only difference is the expense ratio. When we talk about direct plan, the expense ratio is little lesser compared to regular plan, because some expenses like fund management charges or operational expenses, marketing expenses will remain same. But because there is no distribution commission, and that is why the expense ratio in direct plans will be little lesser, generally 0.5% to 1% in equity schemes. So investors or Gen Z, we are talking about them. If they really have good knowledge about market, um, themes, sectors, and they can take right decisions, then they can go with the direct plans. But otherwise, in most of cases, regular plans may be more beneficial in long term, because sometimes you may have knowledge, but you may lack discipline. When you invest through a mutual fund distributors, you have a guide with you. So you stay invested for long term compared to when you invest in direct schemes, because emotional biases may exist, and when there is correction in the market, there is a means we have seen this more frequently, that investors who invest in direct plans, they switch from one scheme to another scheme frequently, or they exit, they cancel their SIP during the market turmoil. But when you invest through a distributor, there are chances that you will stay longer, and that is why spending little less, spending little more with a regular plan may not hurt you in long term.
Exactly. This is what we are really talking about. Direct schemes give control, but they also come with responsibilities. For Gen Z's investors, they want to manage everything on their own. So definitely there must be some, a list of do's and don'ts, common mistakes that young investors should really avoid, because here we are talking about everything doing DIY. That's the new trend that our Gen Z's are picking up on. So, when does a Gen Z investor actually need advice instead of going fully DIY?
Exactly. See, as far as transaction is concerned, I understand they can do the transaction, but picking the right schemes, picking right asset classes, setting their financial goals, that is very, very important. So one thing can be there, that they take advice from the uh, registered investment advisor, and then they invest directly. That may be helpful for them. Otherwise, making the choice on their own and investing which is not aligned with their financial goal may not be really means beneficial in long term. So when we talk about those, first things, set your financial goals. Start with large caps or flexi cap, especially large cap passive funds, index funds, and flexi cap funds. And as you have more experience and knowledge, then you can add mid cap, small cap fund schemes to your portfolio. Do not invest in small cap initially just because of their recent past performance. Set goal and accordingly make choice of your investment schemes. And two, three schemes only to start with will be a good choice. Do not have many schemes in your portfolio. Second thing, invest through SIP route in staggered manner rather than investing in lump sum initially. And keep monitoring your portfolio regularly, not every week or every day, but once in 6 months, once in 1 year, you must monitor. And whenever it's required that the investment is not aligned with your financial goals or selection of scheme is not good, you can make changes in your portfolio. But yes, do not monitor, do not make changes very frequently. See, when you select a scheme, it may not perform for some time, but does not mean that you have to make changes, because when you invest in active funds, fund managers also make changes in the portfolio. So one way they are making changes, at the same time you are making changes in your portfolio will not be the right thing to do, and that is why you should stay invested for long term. Second thing, the most important, what not to do. See, whenever markets are correcting, their correction in the market, you should not cancel your SIP. If markets are not performing, the chances that your schemes will not perform, but does not mean that you cancel your SIP or exit your investment. See, SIP gives you the benefit of rupee cost averaging long term, and that is the beauty of this product. That whenever market comes down, you get more unit, and in long term, the cost of purchase is averaged out, and that is why if you have selected a financial goal, your goal will remain as it is, though markets may fluctuate, and that is why you should stick to your financial goal. So if you're investing on long term, you should invest more in equity. If it is short term, it may be a debt fund or hybrid fund. So choose the scheme based on your financial goal, based on your objective investment, your risk appetite, and then stay invested. Do not change scheme frequently. Do not stop your SIP when the markets are not performing, and do not switch from one scheme to another scheme very frequently because one category of scheme is not performing during that period.
Absolutely. I mean, that's a lot of things to note down, but then, just take it one step at a time. And we really don't want you to make it a very complicated process. It's just to simplify and few things that you need to take care of because it's going to be DIY. And it's really something to be very proud of, taking care of your own financials and your investments in your hand and guiding it and navigating through it. This is the rule book that Gen Zs really need to keep in mind. And with that, we will wrap up this particular segment on the Money Show, and it's time for a short break. But then post that, let's bring in our viewers and let's solve their portfolio queries on the show.
In association with World Gold Council, Gold ETF, it's Aaj Ka Gold.
It's time to answer your portfolio queries, and let's just also flash our WhatsApp number and email ID so that you can send across your questions, because this is the only show where we help you navigate all your financial decisions and investment decisions and help you align them with your financial goals as well. We have Pankaj Mathpal for our guest for the day who will be answering your questions. And Pankaj, hi, welcome back. Let's take the questions one by one. We'll take Ashish Moria first. He's from Varanasi and he's just 29 years old. And he's been investing since 2021 with the long-term goal of accumulating 1 CR in 15 years. Current SIP is 13,200 and spread across 13 different mutual fund schemes. That's what he said. But then now he wished to consolidate his portfolio, streamline it, because he's realized after doing a lot of research and obviously watching the show that he's over diversified in certain areas. He's looking for guidance for a short-term investment as well, 1 to 3 years, and he plans to invest lump sum around 3 lakhs over there. So what mutual funds is recommended for that, and whether the current fund mix, should be streamlined, exit, or any other funds that should be included. And for short-term investment, definitely he has a very moderate risk appetite for which he wants a recommendation. I will not read out the funds because there are 13 of them, but it's flashing on the screen, Pankaj, and you also have the details. So let's begin, and let's start with the short-term goal.
Yeah, for short-term goal, Kavita, I'll suggest that he should invest in flexi-cap fund or say that asset allocation fund of fund kind of schemes, because 1 to 3 years will not be the right time to invest the whole amount in pure equity. So my suggestion is ICICI Prudential Dynamic Asset Allocation Active Fund of Fund. That is one. And in addition to this, as I said, he should invest in flexi cap fund. So he has some schemes in his portfolio. He can top up those schemes. Like Parag Parikh Flexi Cap Fund is already there in the portfolio. And along with that, he also has Tata BSE Sensex fund. So in these two schemes, he can top up. And along with that, the new scheme, ICICI Prudential Dynamic Asset Allocation Active Fund of Fund. So that is the plan for short term. But as far as his existing portfolio is concerned, Kavita, as you said, he has 13 schemes in his portfolio. And if you see the schemes also, there are some thematic and sectoral funds. So as he's a long-term investor, my suggestion that he should definitely stop SIP in some schemes. So I'm recommending few schemes here from his existing portfolio. And these are Parag Parikh Flexi Cap Fund, Tata BSE Sensex Index Fund, UTI Nifty 50 Index Fund, Kotak Mid Cap Fund, Invesco India Large and Mid Cap Fund, which was earlier known as Invesco India Growth Opportunities Fund, what he has mentioned, but now it is Invesco India Large and Mid Cap Fund. So these are 5 schemes out of 13 schemes he has right now in his portfolio. In addition to this, I'm suggesting one scheme. He already has small cap fund in his portfolio, but he should cancel his SIP in that scheme as a small cap. And I recommend Bandhan small cap fund to him. So total 6 schemes, 5 out of the existing portfolio and 1 new SIP. He should start. So 6 schemes for SIP, and for lump sum 3 schemes I have suggested. 1 is only new and 2 are from the existing portfolio.
All right, so that's the recommendation for you, Ashish. Please streamline your portfolio and just hold on for time being, from adding any more funds in your portfolio, because it's very important for you to, have a disciplined approach and just maintain consistency in your investing. Let's move on and let's take Harsh's question. He's from Mumbai. Pankaj, he's 38 years old, 3 CR in 15 years, total value 16 lakhs. The funds he has: Parag Parikh Flexi Cap, Motilal Oswal Mid Cap, Tata Small Cap, HDFC Flexi Cap, 10,000 each. And he wants to add more 15,000, and for which he wants to know what should be the fund mix. Existing SIPs going in the funds, are they right? And is he well diversified? So a good question, Harsh, and diversification coming in from the caller. I think really signals us that people are taking care of diversification, asset allocation, and something that we used to just discuss and help our viewers understand. And now we are looking at people opting for these kind of basic rules of investments in their financial portfolio.
Exactly, Kavita. I agree with you. In the previous question also, the investor himself asked that whether he should reduce the number of schemes. So they understand that too many schemes in the portfolio is not the right thing. And similarly, in this question, he has asked about the diversification. So really, it sounds good. As far as his portfolio is concerned, it's very well diversified, and choice of scheme is also good. So he should stay invested in the existing schemes. But in addition to this, because he wants to add more schemes for the portfolio, like 15,000 rupees fresh SIP, he wants to start with. For this, I suggest Kotak Multi-Cap Fund, where he can start SIP of 10,000 rupees per month, and one more scheme, ICICI Prudential India Opportunity Fund, and 5,000 rupees SIP can be started in this scheme. So for 15,000, 2 schemes, and existing schemes are good. He should stay invested and continue his SIP in those schemes. And as far as goal is concerned, see, he has already accumulated 16 lakh rupees by now, and 40,000 existing SIP plus 15,000 additional SIP, total is 55,000. So he can expect something like 3.50 crore, 3 crore 50 lakh rupees in 15 years without step up. But as we know, in long term, the value of money get reduced because of inflation, and that is why I suggest that he should step up his SIP year after year. If he steps up at 10% every year, he can expect around 5 crore 43 lakh rupees in 15 years, and that is the right strategy. So my suggestion that he should step up at 10% minimum, and whenever he has more money available, he can top up his portfolio.
Absolutely. So, Harsh, that's the advice for your portfolio. But then let's move on. And okay, Pankaj, let's take the next question. This is from Bhupesh, and he's from Uttarakhand. Current portfolio value is 8 lakhs, NPS value is 4 lakh, HDFC Defense is 5-year duration. It's a sectoral theme, and rest of the funds he wants to hold for 20 years. And he wants a large cap suggestion, and he also wants to know if that should be an active or a passive fund. So, lack of details, but if that is the only fund he has in his portfolio, HDFC, then I think he really needs to diversify. And, we really don't know about the other aspect of his portfolio, but assuming that's the only fund he has, definitely sectoral theme. So he needs to, he's taken stock of that, which is good. Rest of the funds he mentions are there for 20 years, which means he has other funds also in the portfolio, but he doesn't have a large cap. So let's just give specific recommendation depending, the way he's asked, basis the details in the questions.
Because for long-term investors should invest in diversified funds only because themes and sectors keep rotating. So if you talk about defense theme, it looks good as of now, but we do not know that how long that theme will perform well. So that is why my suggestion that he should stay invested right now. But I cannot say that for 5 years whether the theme will be right or no. Every year he should review the performance of the scheme and the performance of the theme. And if he finds that he should continue, he should. Otherwise, he should exit. Because for long term, you can stay invested in diversified funds. But if you have thematic and sectoral funds, you will have to change it based on the situation. So for next 1 year, he can stay invested with HDFC thematic HDFC fund, defense fund. But later on, he'll have to take decision based on the situation. For large cap, my suggestion will be passive fund. He should consider either SDFC Nifty 100 index fund. That will be a good choice for large cap. Otherwise, if he does not have a flexi cap in his portfolio, he can consider a flexi cap fund which has a large allocation in large cap. Why I'm saying this? Because when you invest for long term, only investing in large cap may not be very suitable for your long term financial goals. Flexi cap fund can be a better choice because fund managers they have flexibility to switch from one kind of market cap to another type of market cap, from large cap to mid cap or small cap, and that is why you can also consider ICICI Prudential flexi cap fund, but only if you do not have a flexi cap fund in your portfolio. Otherwise, purely large cap, my suggestion will be HDFC Nifty 100 index fund.
All right. I think with that, it's time up on the show as well. But thank you so much, Pankaj, for being on the show and navigating our viewers through their investments. And for the viewers, I'm going to leave you with our WhatsApp number and email ID where you can send across your questions. Thank you so much for watching. Goodbye.